So we're all excited you're here. My name's Andrew Falde. First time interacting with most of you, I believe. We got Craig here today.
How's everybody doing today? Good to have you guys on. Super excited to be able to go over the information that we've got today for you. Andrew and Joey in the background have done a lot of work to get us ready for this today. So we're excited to present this stuff to you.
Today we're talking about how real estate investors can win in any market cycle by stacking 5 competitive edges. And that's our subtitle, but if there was a subtitle, and it's very important, and we're going to hit on this point, but I want to hit it early, and we're going to try to hit it often, that we are talking about edges, advantages, and profitability, and nothing you will hear about today assumes or presumes market appreciation. This is not about how to leverage market appreciation. This is how to have a true competitive edge for outsized return and controlled risk without having to rely on market appreciation. All right. So we're going to go through just to as you see these, we're going to bring up some of the common struggles that real estate investors have. And some of these will resonate with you, and some you may recognize them, but not resonate with you. But as we go through these, just kind of be thinking in your head, like, yes, I'm familiar with that, or, oh, no, I've never really seen that problem, that I do understand it better now. And then we're going to talk about the edges. We're going to talk about how those edges overcome these common struggles. And really, by combining, it's about the stacking and combining of these competitive edges and advantages that allow you to overcome these struggles and not depend on appreciation or leveraged appreciation in order to be successful. So the first reason of our sampling today on why investors struggle is relying on one exit strategy and not having backups or not having other alternatives on how to exit whatever the investment is. And so the exit strategy is, as it goes up in value, I'll be able to sell it to the next person, or the pro forma says rents will increase, so my IRR should be very strong because I'm borrowing money, so I'm leveraging that appreciation, at least to not have any depreciation. So Craig, tell us a little bit more about the why not having more than one backup is a struggle for real estate investors.
Yeah, that's even just starting off with this, Andrew, I think is a key, because with the amount of investors that we talk to and deal with, and the amount of deals that come across our desk, I think so many people look at deals and they're evaluating, they're looking at, and the number one thing that I see that people look at as well, they're automatically counting that a deal is going to appreciate on average 2% a year or 3% a year. And I know historically, if we look back from a data-driven perspective over the last 60 years, right? Historically, that 2 to 3% is true. But the reality is, if we look at what we've got right now, the market that we're in many areas throughout the country, if your deal was based on appreciation, you're going to lose right now, right? So it makes it very difficult in this time. So understanding that you need to be able to pivot. We did a big show last October, November. And that was one of the things we talked about, is understanding pivoting. And I think that's a big key, is as you start a deal, if you don't have multiple exit strategies, whether it's extended time, changing your equity layer, changing your capital stack, whether you're going to flip it, whether you're going to hold it, determining those exit strategies, maybe it's bringing on partners, maybe whatever the exit strategy is, if you've only got one, you're really starting to limit yourself in that process. So that's one of the things that we look at, is every time we're evaluating deals, if we don't have at least 3 options on exit, it's just not a deal for us.
It's too narrow. It's
Yeah,
too slim of an opportunity. Yep.
exactly.
Second, why most real estate investors struggle is analysis paralysis. And the reason for it, that's where you end up. You get stuck and you realize, like, I've run out of time. I'm not going to be able to make this decision. And you just get stuck looking at stacks and stacks of deals and not pulling the trigger. And the underlying reason for that is the limited resources to underwrite quickly that lead to a lack of confidence. And those resources can be people, but it's also knowledge and experience. So thinking of like arrows in your quiver, this is the experience and like drawing from memory. Oh, I've seen how deals like this work, or I've seen how we can fix this one problem. And you're not able to underwrite in a way that gives you confidence, at least without not paying exorbitant fees to somebody who could do the analysis for you. But with that, then you'd be limited on the number of deals you can look at. So analysis paralysis. So any comments you want to add to this?
No, really, that's the biggest thing. I think a lot of investors, especially when they're starting off, we get this question a lot when they're starting off is, we were looking at deals and they lost out. And I think a lot of it is, okay, understanding what your capital stack looks like. What's your exit strategy? I love that we started with exit strategy first, because if you don't understand that, understanding how to underwrite a deal can be very difficult. So trying to determine your parameters of what you have available as an individual investor, I think is key. And that will really speed up your ability to underwrite a deal.
Got it. Awesome. So another is limited to familiar opportunities only. I'll add that word to this. And so that's common, like what's in your backyard, what's around you, only the local market, or you're only looking at single family, you're only looking at duplexes, you only look at fix and flips. And it's because that's where your comfort zone is, and that's where you're limited, and that's going to greatly reduce the number of opportunities that could work very well for you. And then I'll let you chime in on this no seat time metaphor that you have.
Well, yeah, I didn't know you were putting that in there. That's awesome. I know we talked about that the other day. Um, just so everybody knows what I was talking about that, I've got a big background in site development and equipment operating and things like that. And so when we're hiring operators, we're looking for the guys that have good hand-eye coordination. They've maybe, played a few video games and they've been in a machine for, 100 hours, right? Well, those guys can drive a machine, but they really don't know how to operate. When we're looking for really quality operators of $500,000 pieces of equipment, we're looking for guys that have thousands of hours of seat time, because that means they've seen and done and experienced more things. And I
Mm-hmm.
think this really plays back to investors just don't have, if they're starting out, the more seat time they get, the more deals they experience, the more deals they see, the more sometimes, even when you're starting investing, the more deals that you're in that sometimes you don't win out of allows you to see, well, that's a strategy that I need to, whether I need a different capital stack or I need to have more exit strategies, whatever it is, to become better at that. But having that seat time in understanding deal flow and opportunities, what those really look like and what makes sense, I think seat time is crucial to success.
Awesome. And then I don't know how many, we don't have too many more struggles, and we don't want to leave everyone or have everyone just start off, all despondent from our opening here, but there's a few more. So always hunting for the next deal that fits your available capital. And the reality is, as you look across the market, or as you see what comes, or if you're on a newsletter or a distribution list or in a group, and the deals that come across, a lot of them are just going to be too big. That's the case. And some of them are just too small, depending on where you are and what your capital availability is. Some are too small, at least to be worth your time and attention. And you maybe think, okay, so I'm talking to DBL Capital, a REIT, a fund. You say, well, you must only do giant deals. And the reality is that's not true because of the systems that are in place, because we have to buy individual lots to buy houses. And those are very small deals, but we have the ability to fit those in without taking or not having the time for it. And very few are just right for what you, as an individual investor, have available at least right now. Because some money's tied up, some's available now. And then, we'll talk about 1031s in a minute, but so we won't get to that yet, but that's a different issue. And then unable to make great deals work because you don't have the resources or the team or the ability to swing at the bigger hits, the swing at the bigger, the big hits that come your way, because it just doesn't fit what you have available today, because what you have is tied up. So anything you want to add to that one?
No, I mean, honestly, Andrew, I think the biggest thing out of that I would take away if I'm looking at this one is like you said, some people look at them, they're too big, some people say they're too small. I think successful investors are going to look at every deal and evaluate, because oftentimes the small ones, you piece those together, and that's what makes really good deals, right? Like you mentioned, okay, for us to build a house and generate the yield that we generate out of our returns, we have to do the smaller deals. We have to do land development. We have to buy infill lots, those types of things. Those are small deals, but what makes it viable for us is having the resources and team to be able to go through and say, here's our criteria and our system that we look for. So I guess, out of a struggle of that, a takeaway is how do people develop their systems to take on small deals that could potentially lead to big deals?
Right. And then another is no leverage without personal guarantees. And that's not always true. There's access to financing without, but often like a non-recourse loan, the terms are less attractive, more capital required, hard money can be very expensive. So borrowing without personal guarantees, and really just the fact that you are on the hook for more than just the capital in the deal. And if you aren't and you have other access to it, it's still very challenging. And even inside, if you get a traditional loan, the time that it just takes more time to get the leverage that you need in there. So that's one. And then we'll just keep blowing through, and you just interrupt me if you want to stop and cover a topic. But the trying to time the next deal, similar to the one before, but very specific to rolling your money. This is what this one's about. Trying to time the next deal to start right after the current deal. And this is especially true for 1031s, where you feel rushed into it, or if you can't get the deal done, or you can't, even if it's not a 1031, you're trying to find the next deal, your capital moves to the sidelines, not earning, or at least not earning more than a few percent. And then, or worse, you rush into trying to roll forward on a 1031, and you rush into a bad deal and you wind up losing on that one when you would have been better off just paying taxes and going to the sidelines. And the struggle here, and what we have seen in many conversations, comparing, what are the returns where you are versus what I've been able to accomplish, and why it's not apples to apples. And I'll let Craig explain this, but the three topics, the three things on that last bullet point are return rate versus turn rate and the perceived yield. So Craig, comment on that.
Yeah, in so many conversations we have with people for the last, well, I mean, I'm 52 years old, done this for 30 some odd years now. In that process, I have so many single investors that look at it and say, well, why would I want to partner? Why would I want to JV? Why would I want to be a part of a fund? Things like that, different structures, right? I want everything. I want it all. And I think part of what we're trying to get to and show today is that, yes, if you're the single guy, you get the whole piece of the pie, right? But the reality is that is your cash on cash return rate. But the reality is if that job takes you 9 months to complete, and then you got another 2 months to turn it, that's your annual out of that, right? But then how fast can they turn that revenue again? How fast can they turn the equity? And that's what I try to get investors to see is there's a difference in your return rate from a cash on cash perspective. But the real way to make money is about how does that turn rate work, right? How fast are you able to turn capital and keep it always working? Because the moment
Mhm.
that capital stops working, then at that point you're really not making what you believe you are, and that's where it comes into a perceived yield. I talk a
Mhm.
lot about that in our seminars and things, that people believe that they're making a 65% return on that house, or a 90% return on the house of their equity. But the reality is, if they can't turn that, they may make it on that job, but if they only turn it one time a year, well, the reality is that turn rate is not very good. So the real perceived yield is not there. Versus, when you've got a larger entity that can turn capital faster, and now I'm taking deals and doing them 2.5, 3, 4 times a year with the same capital stack, Now that perceived yield is actually much higher because we're actually turning the same equity over and over and over again.
Hmm. One of the ones I've seen, you negotiate with a builder or a contractor to do your fix and flip or your new build. And by the time you negotiate them down low enough where your yield is high, you're now the least important person on their list of projects. And
Yep.
so yours now, all the other jobs take 8 months and yours took 14 months. And so it's 14 months to earn your 60% instead of 40, because good job, you negotiated well. But then 14 months later, it's finally done. You get it back. At least maybe now you have long-term gains instead of short-term. So there's a win there. But now, how much longer until you start the next deal? You got to negotiate for a while. They're less incentivized to work with you. You wait. So now 18 months later from the start, you finally get into the next deal where you may have been better off not negotiating as hard, taking a little less yield, getting the deal done in 8 months, and then having them motivated to start the next one. So there's a lot in play for, as Craig will talk about later in a different slide, why sometimes you want to take the higher interest rate loan when you have a lower interest rate one available, and how that can play into new opportunities that come to you in the speed and all that. So,
I think one of the just a quick story on that. I remember as a kid, and we talked about this at one of our last seminars about the tools that we have in our toolbox as investors, right? Growing up with my father, he was I'm third generation in what we do, and I remember him as a kid. He'd walk me around to job sites and he would talk about the tools in these craftsmen's toolboxes, right? I never forget as a kid, he was talking to me about, look, son, this guy has all these tools to do the job correctly. I may pay him a little bit more than I've paid somebody else, but because he has the right tools, he can get the job done faster. Now, at 7 and 8 years old, no, okay, he was trying to teach me a principle. I didn't really understand the economics of it. Obviously, now I get it. For him, he was looking at a turn of capital, right? How fast could he get the house done with quality and still turn that capital stack to do that more frequently? That's where I look at the tools that we have in our toolbox is the resources, the personnel, the people, the team behind what we do. And I think that's what I encourage investors is recognizing that differentiation of what does your toolbox look like? What do you have in your toolbox to create a faster turn rate?
awesome. All right. And now we're done with all the bad news. All the red X's are gone. I'm pretty sure there's not one more red X for the rest of the slide deck. So that's good. Everyone can breathe a sigh of release. We're going to get to why you showed up, which is the competitive edges available in real estate. Now, many of these are not available. You just can't be like, oh, now that I know I can have it. Many of these have to be built over time, and you have to learn how to combine them for the best result. So we're going to list these out now, and then we're going to start talking about scenarios where each of these edges can be added or combined to create an opportunity that may not have been available otherwise. So the first one that we have is buying power. And so buying power is cash. One that's not even listed here would be access to cash. So like how deep is your network and how much do they trust you and how much do you trust them and work with them? That there's other available cash to add into a deal or debt sources that are as fast as cash and still economical. So that would be buying power. It's not always cash. It's how can you get access to cash or debt that allows you to still be fast, okay? Which leads us right into number two, which is speed. And speed is how you will lose out. If we're talking, the key word is five, after the number five is competitive edges. Like, why can you get deals done that others miss? Or why do you get them sooner when somebody may have paid more, but you get it for less because you were faster? And that happens with processes, team, people that know you, what you're looking for, have been through things like this. They will fill in the gaps that you aren't able to fill on how to solve problems and all that, and just experience. And that's the one, it's definitely going to take time on that. So you wanted to, we have shiny nickel added in here, and you had, I think, a metaphor on speed with shiny nickels.
Yeah, the one thing that I see out of that as we were going through this earlier this week was I see so many people that get sidetracked because they don't have the systems, the processes, the teams, the experience to make fast valuations and do some underwriting at that pace. And so what happens is they get overwhelmed by just looking at every shiny object, every shiny nickel that's out there, and they end up getting overwhelmed and bogged down trying to evaluate them all.
Mm-hmm.
And I think that's that process is, that I want to encourage people over. And obviously there's an advantage that we have on our systems. But as much as, listen, at the end of the day, Andrew, we're here talking about our fund, the REIT that we have and what we do, right? But I also want to encourage people, like, listen, we're not the only option in town. We want to be your first option, right? But at the end of the day, if you're doing stuff on your own, I really encourage you, focus on the deals and know your systems, because that shiny nickel will cost you money every time if you chase it.
Mm-hmm. So having a fast filter,
Yep.
what are you looking for? How can you disqualify it very quickly? And then how do you know what information's missing? How do you get it faster than other people can so you can have the opportunity for the deal? Knowledge. That's the diverse knowledge and deep research versus where the challenge, this is kind of contrasting, is that you know what you know and that's it. Whether it's your local town, maybe just the neighborhood you live in, a certain type of product, only fix and flip in one zip code. But having diverse knowledge comes from reps, seat time, and also deep research. So it's all that when you're not looking at deals, when you're not trying to make offers and filter through things, and you have that time to take a breath and spend time. Now it's time to look at deals maybe you would never do, but really like get those reps in and expand your perspective and say, like, maybe I do need to look at a different state. Maybe I do need to look at a different type of product. Maybe I do need to look at pooled investments instead of individual deals or something like that. So the knowledge, if you say, well, I don't have it, so I don't want to even start, well, you can evaluate deals, get that diverse knowledge through reps without even doing the deal, but just getting comfortable with those things. Fourth is relationships. So getting out there, going to groups, meeting with bankers, meeting with agents, meeting with investment groups, contractors, etc. Everyone who touches everything that could ever turn into a deal. Letting them know who you are and what you're interested in. If you've done deals or you've done a lot of deals, go ahead and brag. Let them know that you get stuff done. Tell them about the last one you did. And nothing may happen in that conversation, but as you begin to become well known as somebody interested in things like this, all of a sudden you start getting the text messages. All of a sudden you start getting the emails and you start getting told about, hey, did you hear about this? You say, no, I didn't. They'll assume, hey, you're a player. You should already know, right? Oh, I know. I missed it. Thanks for telling me. And then you get to know about things that are not yet on the books. And we have an example in a little bit of one where most people don't know about this deal. We're not going to give you the address either. We still have it under wraps. It's not hit the market yet, but we know about it, that it's coming. And if we can have the buying power, have the speed, we already have the relationships. I'm kind of jumping ahead, but you see where this is going. That deal could happen where other people who would have paid more won't even know what was available. So very important. And execution, I think, is Craig's favorite. It's all about the operators. It's about, how does speed happen? How do you build the relationships? It's execution. So systems, processes, constant improvement, and most importantly, an A+ team who you can go to do, we've got somebody who goes out and finds $20,000 lots, and they're just going out and they're looking for environmental issues and flooding issues or anything like that. And there's a whole system in place and an A+ team who knows how to evaluate all of that. So building up your team to whatever extent you have, or partnering with people who can help you with evaluation and finding what they already know about. Anything you want to add to this slide?
No, I think, I mean, obviously, I think number 5 is the biggest thing that makes or breaks deals. More deals are profitable based on are either profitable or not profitable, I believe, due to the operator, right? I mean, a successful operator has those systems and processes in place, and that A+ team, because COVID 2020 was a perfect example of when everything, it's easy to do deals when everything works perfectly. How do you do deals and how do you overcome challenges? 2020 and 2021 was a perfect example of that. We're building hundreds of houses a year, and all of a sudden, hey, we went from getting trusses in 4 days to we can't get trusses for 14 months. Right? How do you overcome those challenges so your deals don't get stagnant and stuck? Right? I think those are key. And so execution of an operator is just crucial.
In a different webinar, Craig will finish that story, which is a great story, but it'll probably take 15 minutes to tell well enough that yes, he got the trusses faster than everyone else in town and wouldn't tell anybody how he was doing it. So, and weren't you selling? Well, one little thing that was the block, right? You wound up selling to everyone
Block
else.
and trusses. Yep.
So he was able to solve the problem, and then so much so that he was able to share the wealth with competitors. So solution is a typical, so like tying it together, like when you run into a challenge, how do these edges help you? So you can go from having only one exit strategy to many exit strategies. And this is pre-planning and the ability and focusing on pivoting. That pivoting is always required. And the edges are knowledge, relationships, and execution. So if, like you were saying, when it's easy to make money with everything's going right, because you can just go buy off MLS, just be the first one to throw in a full price cash offer, close, wait 60 days and sell it again for a profit. That's like anyone can do that if that's the case. But what if that exit strategy doesn't work? What else can you do? Do you have any specific stories on pivoting?
Well,
I know you do. It's just which one do you want to do?
yeah, I think, honestly, even as we look at what the market is doing right now, right? You've got, with what's going on in certain markets throughout the United States, you've got, you've got markets in Florida that were just amazingly fantastic over the last 4 years. And now all of a sudden, we've got some stagnation in those things, that things are just flat. There's a lot of economic reasons about that. We can talk about those at some point. But then you go and you look at Southern California, right? 5 years ago, Southern California was just dying as far as the amount of deals that were going on. And now you look, it's the number one market, or one of the number one markets in the country right now, right? So understand that pivoting and understanding, knowing how to look at deals and say, hey, listen, we didn't see this one coming, no matter how much data you review. Sometimes you're just not going to see that tide coming at you. Having exit strategies available that are multiple strategies allows you to overcome when the market does something completely unexpected.
Mm-hmm. Yep. So, and you said earlier, if you can't see how 3 exit strategies could work, then we shouldn't move forward. So, for example, if you think, well, this is let's use the easiest one. It's just, well, the market's going up. I'm going to buy. I think I'm getting a little discount here. I'm going to sell it for more in a year. Okay, and so like that doesn't work. So you have to be able to pencil out renting it, right?
Yep.
Or some other scenario where if you can't pencil out a second or a third scenario for your core one, then you're probably not getting a good deal, right?
Correct.
Yeah. And that's why this is the repeat of what was not on the first slide and is kind of threaded through this whole presentation, that if the assumption is market appreciation or even market stability, then it may not be a good enough deal. You have to have more ways and enough margin of safety, a low enough basis, enough other competitive advantages, like I got this so much cheaper than market because of speed and knowledge and buying power, that I can get out of this any way I want. The yield would be great if I rented it. It's going to be great to sell it right away. It's going to be great to fix it first and then sell it. Whatever the scenario is, if you can't see 3 ways to make a profit, then you're probably paying too much. Deal too big. So you come across something and you just ultimately can't pull the trigger. But if you can solve that with pooled capital or bringing in partners, and that is the edges of buying power and relationships. And again, those 2 things don't happen just because you realize it and now all of a sudden you have it. Those have to be developed. So buying power, which we talked about, is cash, access to cash, or access to debt that's as fast as cash. access to standard debt, you're just in the same boat as everyone else. It's no longer competitive. And all of that comes from relationships, if it's not your own cash. And so building those relationships should start today, should have already started. That's starting now for that future deal that comes across that's too big, where if you lead with, hey, it's nice to meet you, here's the deal I want to do, that's a lot harder. That's not a relationship. That's transactional. If it's, I've been talking to you, we've looked at deals together, I've told you what I've done, I've told you all the things I've said no to, like, hey, I saw this one, I turned it down, and you're just sharing stories, you're building relationships. Now, when you come to them and say, hey, I got something that could really work, do you want to look at it with me? That's a relationship. That's not a transactional, like, I just have this person on a list, let me go ask them. Anything you want to add there?
No, I think you're good on that one.
All right. Deal too small. We talked about this one a little bit already. Having trained staff to handle acquisition. It could be a real estate agent that is willing to put in that extra work because they know you get deals done. So this is an execution, teaming, relationships. There's probably some other edges you can throw in there, but it really falls in that execution and saying, do I have a system and process and quick filters so I'm not bogging people down. I don't want to look at every small deal. Do I have a quick way to filter to possible opportunities that I can let somebody else get through? There's 1,000 things out there. The filtering got it down to 100. My team got it down to 10, and I can make the final decision on those. And that's how you can actually get through small deals. And as we know, like, small deals can have the higher yield. So if you're able to compound or stack those up, that's where you can get better. So I'll just let you interrupt whenever you want to chime
Yep.
in, and then we'll be able to move on to some other important stuff. Unattractive leverage. This is where we are starting. I think it's always important when we start to transition from teaching you to telling you what we have to offer. That should be a very natural. You should know what we're doing. All right. So right now we're going to start talking to you about how we do things different, and this one very point covers that. So unattractive leverage versus knowing how to have a borrower as a partner. And that term, I put it in hyphens there because it's kind of like SaaS, software as a service, like the borrower as a partner. And that edge is buying power, knowledge, and relationships. The knowledge here is what we're giving you, which is that DBL Capital is a borrower as a partner, that you can have leverage without personal guarantees, leverage without going out and finding debt, that the leverage is built in for you into the fund. And then efficiently rolling deals is a challenge. The other thing that we do inside is it's an evergreen fund where lots of small deals that you are a part, not small, but a whole portfolio of deals that some would be too big for an individual to be in, and many are too small for them to manage and want to deal with individually. But those are turning constantly. And when there's an opportunity for a 1031, it's actually happening passively inside of the fund and being passed through to you to offset gains from other deals. So that efficiency and where we talked about capital being stuck on the sidelines versus being able to get into the next deal and roll forward quickly and not make bad 1031 mistakes, having a structure where all of that's happening inside of it. And that's really stacking a lot of edges: speed, knowledge, relationships, and execution. Speed in, if you have inside of a fund, the parent company owns a construction company, well, the deals are getting built faster and they're getting repaired faster and fixed faster. The knowledge is there, the relationships that have been built, execution are all to your advantage when you can be a part of that. And this is where it's kind of push button edge. Like these are edges where it's very hard to build this up on your own over time, but these are ones that are available through what we're doing. So, Craig, I'll let you talk through how these two work. So we're going to do the old way. So how people used to be able to work with Craig, work with DBL Unlimited and the subsidiary companies. The only way they were able to get great deals and high yield that way. And then we'll talk about the new structure and how we've kind of gone to the next iteration. So here you
Yeah.
go.
So the way we've done things over the last, I don't know, 8, 9 years, in working with investors was we required them to do bulk purchase, right? They had to do a minimum of, let's say, 10 buys at a time. So we worked with the equity stack or the capital stack on that. We brought lenders to the table that provided aggressive rates for them. That they really worked well with us on timing of draws to keep capital moving, to keep the build cycle moving. But the reality was, between, because they were signing, they were putting the equity in, and they were personally signing for the debt. So the reality is, between their equity and their debt service on that, they're for those 10 deals, they're at least $1 million at a, I'm sorry, $5 million at a time, or more, depending on which models they were building, things like that. So the reality is, while yes, there was good yield in there for that, as long as the timing of the market went well, things like that. Obviously, in this last 9 months, some of that has been a little challenging for a few of the investors that were carrying out some of the last few contracts, because there's been a little bit of price damage of where these houses are ending up compared to where contracts were when we started, based on pricing of goods and services, things like that. They were still getting a wholesale pricing, but the reality is they've had to say, all right, now we have to pivot, right? Now
Mm-hmm.
we've helped them through that type of process. But at the end of each deal, they had to start over. They said, okay, this deal is done. Now I'm ready to go again. So the reality is, if they didn't have additional equity to keep that flow moving, they had to finish one. And they said, okay, now we want to take this equity and we want to start over. Well, there's time lost for starting that process again, right? Because now we talked about it earlier about the speed of execution. So what that did is it said, okay, now they've got to start and finding more land. We have to do all of those processes over again, versus being able to be ahead of the process for them,
Mm-hmm.
which
Yep.
meant,
So that's, yeah, versus somebody that said, "Oh, I want to, build a house with you," and that's great. And you're like, "Well, if it's one house, I can't give you wholesale pricing. You
correct.
know, one house is, the person going to live in it. That's who buys one house, and they're going to pay retail.
That's
So the
that's
only way to overcome uh, pricing, so where you're not depending on appreciation. In fact, you talked about the price damage. Their equity is still safe in those deals because the basis is low enough. So to get that wholesale pricing, you had to come in with massive buying power to overcome that. And so it left some challenges in there. There was a whole structure available to make, faster builds, good yield, not depending on the market to rise, in order to be profitable, quite profitable actually. But it took a lot of buying power and a lot of still personal involvement, like you said, as each one falls off. All right, now I have to decide, am I putting it back in? How am I going to do that? I got to go pay taxes on this one. All these different things, where there's still a lot going on.
what you said there. The one thing about the taxes, that's one of the key components that I've stressed for our investors for a long time. Is, I don't think they realize, or I'm not just going to say they didn't realize it, but oftentimes it's that shiny nickel, that shiny object syndrome, to where we say, oh, I'm getting this return, right? But at the end of the day, you've created a taxable event. Well, if we didn't hold it long enough for it to be rolled into a 1031, so at the end of the day, you built it and you sold it.
Hmm.
Yes, you had a decent return out of it, but by the time you start chewing out capital gains out of that, maybe that wasn't as enticing as what it should have been, or what you thought it was going to be, right?
Hmm.
Still good numbers, because at the end of the day, they're not out there building the house. They're not out having to manage crews, things like that. But it was very capital intensive. And what we saw, Andrew, is it left a lot of people on the sideline that wanted to get in that game, but they're like, man, I got $1 million, or I've got $500,000. I don't have 5 million, or I can't lay all this capital stack out there. And so we started seeing that we've got to evaluate things and provide different opportunities for two reasons. One, to include more people, but secondly, if we're going to continue scaling our business, we need to provide better options.
Yep. And so that brings us to the new way. So by the way, the old way, um, was well over $100 million was processed that way in transactions and deals and construction. Very high yields, very successful, and great. But now we're going to move on to the next iteration of what's available and how to participate in a way that continues to overcome challenges, bring in more edges, and that's where the fund comes in, the REIT. So here are the highlights of it, and then we talk in detail about it. So with the fund, instead of having to outlay 7 figures plus and or borrow multiple 7 figures, it's 6 figure access to wholesale pricing. The capital is always at work. You become part of a machine that is doing a lot of deals, and they're always something's being brought in even before we're ready to start it. We know it's coming, so we can be bringing things in all the time. Diversified exposure to deals of all sizes and scopes. There's no longer, I only understand this kind of deal, I can only get into this one right now. That if a $15 million deal comes along through the fund, you say there's no way I'd ever be able to figure it out, put the capital together, work with people, evaluate it. That's going to come through. Or you say, hey, we need to buy another $20,000 lot. I wouldn't have the time to go figure that out, solve the problems, or not accidentally buy one that has some protected species on there and now we can't use it anymore. Like all of those things are handled, and that's done inside of a fund. And the deals roll forward inside the fund. You're no longer having to make individual decisions and choices on, hey, this one's done. Do I want to redeploy or not? What do I want to do this time? Which model do I want? All of it's handled inside. And the way it's structured as a REIT is it's full tax through benefits, including the 1031s that happen inside, which can offset the yield from higher returning investments and projects. And a really big one here, and I've seen this, I've heard these stories with individual investors say, oh, I've got a builder, he'll do it really cheap. He does them for me. Or I use this builder, and I only have to pay him $10,000 to build my house, or I have a contractor who gets it done. And the reality is we talked about this earlier, the lower you get the price and the more you negotiate down, especially if you're doing one deal at a time and they're relatively small, is that you're now the least important person on the list unless you're doing high volume. So now you have to have one edge and not the other one, right? So if you have not a lot of volume and you have a low price, you're not going to be the priority. Now everything's going to move slower. You're not going to be taken care of as well. They're going to put the lower skilled people on your project. Like all of these things are going to happen. In a fund structure, even if you are the smallest investor in the fund, you have the same priority as the largest investor in the fund because you are a co-owner of everything equally. And there's no more, well, how come their deals got done 3 months faster? How come theirs sold and mine didn't? Their lot looks nicer. Why didn't I get that one? It's all equal and it's all prioritized the same at wholesale rates with less capital required. So that is the total stack. What else you want to add to that?
No, I think it's pretty straightforward on that. The biggest thing that I would push through on that is inside a fund, the key is going back to the pace of turn, right? Perceived yield versus a pace of turn. Inside our fund, remember the way that I've intentionally set our waterfall up is that the investors make their money first, right? They get the first lick of money before we ever get paid. And I believe in that because I want all of our investors to see that we want you to make money before we do, because that way I have to be ensured that the fund is profitable, or else I never get paid, right? So I think that's a crucial thing in how we've set this up. But the other aspect is on the full pass through, because again, we're not evaluating deals based off appreciation, right? So in that, based off the evergreen status that we're building for yield, and then we're buying and holding for two things: cash flow as a diversified income stream, but also for depreciation to start working on wiping that taxable events away. Those are strategies that if you don't have enough horsepower in your team, they get hard to chase all that down, right? And so that's a lot of what we focus on. So
All right, now we've got our a sample deal, and let's see what the time is. We do have time for it. So there's two things we want to run through is an example of how we use the team evaluation processes, this knowledge edge that we have, relationship edge. And so it's just an example of a deal that we're currently looking at. Then Craig has a spreadsheet to go through basically pro forma projection of how the business plan is set up for yield, for pass through, all of that. So if you want to go through this deal and then we can jump to the spreadsheet.
Yeah, so this is an interesting deal. This is one, again, in DBL Unlimited, we own DBO Capital, we own Douglas Brook Homes, we own Trinity Building Designs, mortgage companies, a lot of different stuff, right? But the Trinity Building and Designs, we do shell construction, concrete, block, framing, all the structural components. This is a deal that we did all the structural components on. We were brought in to do that for another GC that is building for a venture capital group, a VC group that's actually here in Southwest Florida. Unfortunately, they didn't do their due diligence correctly. They underfunded their capital stack, didn't set that up correctly, really hired the wrong head GC. They've mismanaged the product, and now the VC company's out of money, right? So they're going out of money, they've run out of money, and what we found out is they're trying to sell the deal. So in that process, we've been in some initial phases of due diligence with them, working on this. We know where their budget's at, things like that. So it's a 106 unit apartment complex here in Southwest Florida. To purchase, complete all of that, we would be right at about a little over $20 million to complete. Without any unknowns, things like that. The project's already at about 55-60% completion. I know there's some savings off of the budget, things like that, where we could go. I may be able to get that total price through there down. We're still working on some final budgets of that, or final numbers of that. But the completion of this right now, conservatively, that project would appraise and have a valuation at about $25 to $26 million. So you're looking at a little over a 20% equity stake in that built into it, just based off the purchase price. Because we're looking at trying to get this before anybody else on the market is grabbing this product. Again, with Douglas Brook Homes, then being able to go in, take that project, finish the completion. We know the timetables we can set. We've got all the trades that we can bring in, use that project, which makes these types of deals interesting to us and very palatable, is because we can do that versus having to go out and shop for more GCs that we're going to pay, especially on large commercial deals. There's not a whole lot of wholesale deals in commercial right now. So being able to go in and look at that, and know that we can offer that at really, really competitive rates to the fund, make that good. But the biggest key that is very interesting in this is, we're looking at this will have a really, really good cash flow at only about an 86 to 88% occupancy rate. Still have phenomenal cash flow with a strong cap rate. But the bigger thing is, on a project that size, the depreciation that we're able to capture off of that, without even doing 179 of going into accelerated depreciation, just off standard depreciations, starts to create a lot of room to start grabbing back from a tax perspective on yield that's created throughout all the other projects that we build and things through the year. So from being inside the fund, when I'm looking at that on a taxation level on a K1, becomes very, very exciting in that process to see, like, hey, these are the deals that can really start to make the full net asset value growth of a fund very, very enticing of how that looks inside a fund.
Yep. And that's where this project, or one of the other ones that comes across anytime, because they always come across. This is just one that is in right now that we're looking at.
Let me catch you off there. Talking about come across. I literally just this morning had another one that's 214 doors come across my desk in a market that we've already got good management facilities in, things like that we would be in at about a 24% equity right out the door with anything else involved. So There's good VE that we could go into that, good upsells to build it. So those are the types of deals. Several
They're
times a
coming
week,
in.
these
Yep.
types of deals come across our desk.
And so there's built-in yield. We're talking again, no, we're not talking about pro forma. If the market goes up 3%, we borrow against it and the IRR will be super attractive, cash, whatever. It's just low basis through execution, finishing out a project, solving the problem, knowing the people who can tell you about it ahead of time. But the strategic component that we're bringing up here is the tax advantage that deals like this bring in, and that offsets the much higher yield that's generated from construction projects. And we have this, but when you get the PDF, you'll be able to look at that. I think at this point, this is a summary. You'll be able to get that too. We've talked about all that. I think right now it's time to jump to the spreadsheet and talk about how is it that we generate the taxable yield that needs to be offset by depreciation. So if you want to prepare to share your screen, I will end mine here.
You gotta let, there we go. All
Oh,
right.
good. I'm glad it worked. Okay.
Okay. Everybody can see my screen there? Is that right?
Yes.
All right. So in this, basically what we've done is I've kind of condensed this and showed a lot of the stuff that we're doing kind of down and dirty in this, but this is one of the models that we build. When we call it this, it's a 1,515 square foot model. Basically what we're saying is, hey, we're selling that to the fund for $204,000. Douglas Brook Homes has their profit built into that. We've got $10,000 for additional site costs on a lot built into it. For the land purchase of $25,000, we're all in soup to nuts at $239,000, right? So the fund is going to come through and outlay for the land, and at that point we'll come down. We basically there's some aspects that Andrew can get into at some point, but on the way we leverage. We've got an aggregate leverage from an aggregate perspective. We can't be over 70% in the aggregate, right? So if I take 70%, that means that at the end of the day, I got to have my land at 25. I only need another 18.5 to be in the deal. So if we come through, and this is based on our appraisal amount is based on our sale amount. So as we come through, the other down and dirty finances of how we pull the deal together, what our finance costs look like. We've got all of our loan amounts, closing costs to close on land, close on the loan, everything involved there. At the end of the day, what I want to get down to is, we sell this house at 315, get our payoff paid out of there. At that point, that's leaving a 27% return on investment, right?
27,000, you mean?
I'm sorry, yes, $27,000 of profit in there. Right now, that house, just looked at comps today, that house is going to be comp anywhere between 315 to 330 as realized comps of closings in the last 30 days, right? So that's not based off stuff from 6 months ago. So in that process, if we're saying, hey, we've got 25 for land and another 18, we're in it for let's call it $39,000. When we're taking 28 grand out of it as a profit margin out of that, that's from an internal per job, right? That's saying on that job that we're producing a 79% internal rate of return. So what we've done, and Andrew, I just put an analysis together. If I scroll up and say, okay, this is based on if we got $1 million in the fund, right? Mm-hmm. So at $1 million in the fund, we're going to be able to build year one. We're going to start about 20 houses. And what I've done is done this very conservatively on saying we're going to roll through houses about every 7 to 8 months. Okay. So again, at doing 20 houses through that process, that's allowing us to do that. Year one, we're doing 20 closings, 40 year two, 40 year three. And that basically times out within a house or two, everything is plus or minus these numbers. Again, a lot of projections in that as far as, from timing of stuff, but that's very conservatively at 8 months of turn time. So in that's also on top of spending the cash outlay out of that. That's not bankrupting the fund to do that. we're keeping anywhere between 25 and 31% liquidity back into the fund. So that's a big key because, we're not just dumping all of our cash out and not having cash reserves. But so at 20, this is where we're going. The fund itself would see a profit of 552, year 2, $1,000,001, year 3, $1,000,001, right? So this is where we come in and again, Andrew can go through you guys with this, one-on-one, things like that later on and stuff. But just wanted to get a quick high-level view of it. You can see we've got a pref that goes out first to the fund investors. Everybody gets 8% of return on investment, or the return on equity is the first set of profit that goes out. Then as a fund, we get an asset management fee of 1.5%. Then there's a target of 12 is what we're trying to achieve as annual distributions on this. So the fund takes its 40%, or it's 40,000 out of it, and then we've got 10,000 comes to the management fee. So basically, that second capital stack is an 80-20 split between the fund investors and the fund manager, right? Then after that, once those products have been sold and delivered, the fund gets to take another disposition fee, because obviously at the end of the day, we got to pay our team and we got to be able to turn a little bit of profit as well. After that first set of capital stack, we've gone pretty aggressive and we're doing a 50-50 split on everything else after that. So in this scenario, the fund investors would still have another almost $117,000 of net asset value growth, right? So that's changing their basis and their accounting within the fund on that, right? So at that point, what comes out is they're on $1 million, there'd be $120,000 paid out in distributions on that year, and there's another 116 that is earned in net asset value growth that stays in the fund to either buy more projects, continue to grow the basis within the fund, but yet at the end of the day, that's an evaluation that goes towards their account. So now their account is growing in value as well as their distributions. So there's two sources of how they're earning out of this. So you can see, year one, between distribution payouts and annual net asset value growth, year one, there's about 236. You can see off of that, where are we at? 40 builds for year 2 and 3, or closings rather. You come back down, you've got an annual revenue in the fund between the distributions and net asset value growth of right at 418. Same thing for year 3. Now again, we're SEC regulated. I cannot tell you that we're promising this amount of money. We can't guarantee that money. But off conservative numbers, those are very good processes of what should come out. And as Andrew talked about several times, if you notice, I've got nothing in here based on appreciation. I've got nothing based on if the market goes up 3%, this is what we do. This is based off where the market's at currently and what could happen right now. Now, again, how do we exit out of this? What's our options for exit? If the market goes, remember, I'm only in this at 70% as an LTV. So that means I've got to have 30% price damage before we're kind of at a break-even point. Well, where are we at right now? In the last year and a half, even Southwest Florida, which is one of the strongest that's been hit over price damage, we're only at 7.5 to 8% price damage. So the aspect, as you can see, we work really hard to make sure as a fund, we're always protecting the equity of the investors. So again, you can see that realistically, year one, on a conservative basis, the numbers look at per $1 million, we should see around a 23% IRR. Again, and I want to be very careful because there's a lot of stuff going out about IRRs right now. That is conservative numbers based on payouts and net asset value growth. But the key to that is diversification across multiple projects, not just one. Like when you're dealing in a syndicated fund, you're on one project. This is based off diversification of multiple projects that we're turning over and over and over. So that speed of turn is what helps to juice this return some, or gives it, let me rephrase it, gives us the ability to do that, right? We can't guarantee it, but the speed of turn in an evergreen fund is what allows you the ability to see returns like this.
Awesome. And so it's very important we have this kind of calculator, more or less, that we go through, because you will see when you go to dblcapital.com, you look through the prospectus and everything, you're going to see it everywhere. You're going to just see 12%, 12%, 12%. And that is the ultra conservative, and very important for us to position things that way, to not say we're targeting this. When these, become history, you'll hear all about it. When now the last 120, 30 million that have gone through, this is the type of experience that you see when you can do 5 million at a time in cash and debt. So this is what we're now moving from, doing 10 at a time, to the fund structure where the economics are better, the efficiency is better, the cost to get in is much lower, aka better. That is, what we are looking at here on a conservative basis. So there's one question, but then we'll wrap it up. There's a couple chats. I want to say hi to John out there. I sent him a chat. Good friend of mine. He came in. There seems to be so much inventory. How will your product compete with all the inventory?
Yeah, good question. So the biggest thing that as a fund we focus on, let me drop my screen there. You guys don't need to keep seeing that screen. The biggest thing that we focus on within our fund is solving the crisis of affordability in our country. Right now, people can't afford to have a home, to have a residence, right? So what we look at is always, how do we handle affordability in whichever market we're in. Like let's talk about the apartment deal that we're looking at. Where we would be with that, the rent rates on that would be somewhere between $1,500 to $1,700 a month for those units. With what the median price or the median household income is in this county, that would put the housing cost for those units at about 24.5% to 25%. Right, to be considered affordable, you've got to be 30% or under. So we're well under that. So everything that we're looking at, even in these the sell products that we were talking about on the spreadsheet there, all of those come in somewhere between 25 to 29% of household income from a median household income in this market. So that's the biggest aspect. And when we do that, what we're seeing right now in the affordable market, those houses are selling in about 22 days. So great question. But the reality is the affordable market, when you look at historical data charts all through the years, you go back to the 80s when you had houses and mortgage rates in the 18s, 17s, and 18s, right? Affordability was still what moved, right? When the higher houses started getting stuck, affordable houses always move. So.
Mm-hmm. Yep. So that is the strategy. That is the mission of the fund, is the affordability crisis, and that's where the speed comes in. Very important. So yes, I think that's as clear an answer as we can give. The inventory there is low, the speed is still there, and our basis, we can compete if necessary and come in below other people and still have a profit. We got one question. What's the investment minimum required?
Yeah, so the good question. The investment minimum that starts out at 250K. Again, compared to our old model where we were at, we were, at well over in the seven figures. The process where we're at now, it's a minimum of $250,000 buy-in.
Next one is, can I 721 into this REIT?
So no, coming into that, any type of transfer situation doesn't allow you to buy into a process like this. SEC's got strict requirements on that. So unfortunately, you can't go into a fund like that.
All right. So once you're in, though, then the efficiencies begin, but there will be a single transaction to get in otherwise. And then, Alfred, I saw your note there on what you're working on. You're in Clearwater. He was in California, 40 years, knew Bruce Norris way back in the day, moved to Clearwater. We're not that far away. Come down and visit us. Let's set up a meeting. All right. So we'll wrap it up there. Just for those who, I know a lot of people are just like, I'm not leaving because the best thing's going to be at the end. So we'll let you go for the day. We'll be back. We'll do it again. Recordings coming out, PDFs coming out of all the slides. If you want the details, you want to go through that spreadsheet with us in a Zoom, we'll set that up. Just reach out and we'll be happy to talk to you about that. So also, any other questions you have for the future? We want to be a very 80-20 type of experience, 80% just pure value that you can take away and use no matter what. And then 20% we'll tell you our stories, what we're doing, and how you can get involved in it. So if you have any questions that you want answered, send those our way and we'll either include them in a video, an email, or another meeting like this. All right. Thanks a lot, Craig. Thanks to Joey in the background, wherever you are hiding, setting this up for us, and everyone for being here.
Yep. Thanks, guys. Appreciate it. If you got any questions, just go to dbl.com or dblcapital.com. Send a link into Andrew and he will reach out to you very quickly.
There's the Joey. All right.
Sounds good, guys. Thanks.
Thank
Thank
you.
you. Have a good day, everybody.
Bye.